The moment the markets have been waiting for. The Federal Reserve's September meeting is this week. So will the central bank raise short-term interest rates? Here with what to expect is Michelle Meyer, Deputy Head of U.S. Economics at Bank of America Merrill Lynch. All right, Michelle, what's Bank of America's base case for the September meeting? Will the Fed finally pull the trigger?
Our base case is that they will. So we do think the Fed will hike interest rates by 25 basis points on Thursday. And we think that the way they will describe the rate hike will be really important. They're likely to characterize it as the beginning of a slow normalization process rather than a sharp hiking cycle. Remember, what the Fed has told us is that they're not hiking to cool an overheated economy or to stop inflationary risks. They're looking to normalize policy from the emergency stance to something still accommodative, but a little bit higher than where it has been.
All right, and one of the things that has been holding back the Fed, of course, is inflation, which isn't exactly cooperating with the Fed. So what do you think the Fed will say there?
You're right. The inflationary risks have probably become more skewed to the downside. Core PCE inflation is only running at 1.2% year over year. So I think the Fed might have to recalibrate their models a little bit. There is a risk that their forecast for medium-term inflation comes down a bit. And I think the way they handicap that is even if they start hiking next week, perhaps they price in through the dots an even slower path of interest rate hikes, given that inflationary pressures are unlikely to be problematic for a while on the upside.
All right, and do you think the Fed will touch on the weakness in China and the market swings we've been seeing? Although anytime the Fed has become a market strategist, they tend to do more harm than good.
Right. So I think they're going to be careful about talking specifically about any market move. They could talk about financial conditions broadly and mention that financial conditions have tightened. And as a result, again, it would warrant a slower cycle. So they could use that as a way to explain why the Fed is likely to be on a very gradual course of tightening.
All right, and speaking of the markets, though, investors are pricing in about a 20% chance that the Fed will lift rates in September and a 57% chance that they will lift in December. I mean, what do you think of that?
It seems low. It seems too low in my opinion. I'm surprised by how much market participants have been willing to price out the Fed this year. The Fed has told us that they have become increasingly convinced that the economy could handle a higher interest rate environment, a very slow cycle towards higher interest rates. And if you look at the data on the real side of the economy, I think it's supportive. You have GDP growth coming in at mid 2%, payroll growth trending at 200,000 a month. The unemployment rate has fallen to 5.1%. So although the inflationary numbers have been subdued, although there's greater risks from abroad, I think the key focus towards the labor market is still supportive of the Fed hiking.
All right, Michelle, we'll be watching very closely. Michelle Meyer, Deputy Head of U.S. Economics at Bank of America Merrill Lynch. Thanks very much for joining us.
My pleasure.
I'm Scott Gamm, and you're watching The Street.